Now, if you've heard about the one big beautiful bill and wondered, okay, what actually changed for my taxes? Well, this video is for you. My name is Merrill Taylor and I'm a CPA, and I'm going to unpack the biggest individual tax changes that are now tax law, what's temporary, what's permanent, and how you can plan so that you don't leave money on the table. This law both extends to major 2017 tax cuts and adds new deductions that matter for real people. Now, the first one is the TCJA individual tax cuts were made permanent. The lower individual rates from 2017 were set to expire at the end of 2025. The new law locks in those lower rates, with brackets continuing to adjust for inflation. That means that there are fewer bracket whiplash surprises and more stable planning horizon coming up. Now, there's an important estate planning note as well. The estate and gift tax exemption is expanded beginning in 2026 to an indexed $15 million per person, or $30 million per couple. So if you're doing wealth transfer planning, this is a big lever that you can use to transfer wealth to the next generation. The SALT deduction, the state and local tax deduction, has been one of the biggest contentions in that bill. It's what took it so long to get passed, because both sides were trying to figure out what's the best way to have that in the bill. So the state and local tax deduction was capped at $10,000. The compromise in the One Big Beautiful Bill was to raise that to $40,000 starting in 2025, so starting this year, for most households with incomes of $500,000 or less. Above the $500,000, it starts to phase down and eventually falls back toward the $10,000 limit for very high earners. And as it is written, the higher cap runs through 2029 and then reverts in 2030 back to the $10,000 cap, which will push even more people into itemizing. So before, we had this cap of $10,000, which meant that far less people itemized. Now that it's been raised to $40,000, we'll see a lot more people itemizing, because now they're able to deduct more of their state taxes that way. So there's a couple of planning moves that you can look at here. So if you're in the highest high tax state, say like California or New York or another high tax state, you can run a calculation where you itemize versus take the standard deduction for 2025 to 2029, and then consider the timing of property taxes and state estimated tax payments to fall in years that you'll itemize. This is often called like a bunching type thing. You can bunch your itemized deductions in a single year to get a bigger write-off in those years. So sometimes people will like double pay property taxes in one year, or they'll wait to make state estimated payments in another year. This is also a popular strategy with charitable contributions. Sometimes people will bunch all their charitable contributions in one year. So now with the state tax, you could actually bunch all of your state taxes and your charitable into one year, get a really large write-off in that one year, and then the next year fall back and do, say, like a standard deduction going in that one year. And that's a way to kind of get a big deduction in one year and still take a larger deduction from the standard in the following year. Now, there were a lot of provisions on eliminate taxes on certain things, such as no tax on tips, no tax on overtime, no tax on Social Security, as well as being able to deduct auto loan interest. So we can get into some of those here. So the no tax on tips, this law creates a federal income tax deduction. So it's not like the tips don't end up hitting your tax return. They actually show as income on your return. And then the people that qualify are able to take a deduction for qualified tips up to $25,000 on their return. And there are income phase outs on this, and we'll make a longer video that kind of goes through the details of all these, specifically, one here on tips that will be coming up soon. And so the Treasury and IRS are finalizing which occupations count, because it only applies to occupations that traditionally get tips, such as servers in restaurants and things like that. The AGI limitations generally start phasing out around $150,000 for single or $300,000 for a joint filer, and they're fully gone in the higher income levels. Also, tips still face payroll taxes and state and local taxes. So expect some additional guidance to come out on this. And if you manage tip workers, keep excellent tip reporting and prepare for updated withholding guidance in the coming filing tax seasons that are coming up. Now, the no tax on overtime, again, we'll do a full video on this that dives into all the details. But here's how the deduction works. There is a new temporary deduction. So again, it's like the tips. The overtime is still going to show up on your tax return as income, but then you're going to take a deduction to eliminate that income from your return and effectively not be taxed on it. So it's a temporary deduction that only applies for 2025 through 2028. It only applies to the amount of overtime that you get paid. So let's say that you get paid time and a half in as an overtime. The exemption only applies to the half part. So let's say that you make $10 an hour, and then if you work overtime, you'd get paid $15 an hour because that's time and a half. Your time is $10, half of that is $5, so you get paid $15 an hour. The overtime exemption only applies to the additional $5 that you're making and not the entire $15 that you're being paid in overtime. And then individuals can deduct up to $12,500. If they are in a married filing joint situation, they can deduct up to $25,000 in that overtime of qualified overtime. And then the phase outs start around $150,000 for a single filer and $300,000 for a joint filer. And this targets non-exempt W-2 workers covered by federal overtime rules. There's an employer note as well that withholding form changes largely roll in after 2025. And there's transition rules that apply in 2025. Now, a really popular one is the auto loan interest. In my career over 20 years, I've never once seen auto loan interest be deductible on a personal return. It's deductible if you use the auto for business purposes, but for personal purposes it has not been deductible. So this is a pretty rare personal deduction. So this applies for 2025 through 2028. It's an interest on a qualifying auto loan. We'll do a full video again on this, diving into the details. But the interest on a qualifying auto loan is deductible up to $10,000 a year. This does not apply to leases. It has to be a purchased vehicle. And then there's phase out starting near $100,000 of modified adjusted gross income or your income, or $200,000 for a joint return. And this is a big departure from the typical no personal interest rule. So you want to track your interest separately from principal and keep your loan statements to be able to document how much interest you paid. Now there's a big provision in there for seniors about the no tax on Social Security. This is also a deduction that comes to them. So again, they're going to report all their Social Security income on their return and then take a deduction. So taxpayers that are 65 and older get a $6,000 per person deduction for 2025 through 2028. This is on top of the normal additional standard deduction for that age bracket. So people that are over 65 years, they get, say, a standard deduction, they get an additional standard deduction on top of that, and then this Social Security deduction would be even on top of that. And it phases out for higher incomes. It's important to note that this does not eliminate tax on Social Security. The old rules on taxing up to 85% of the bill benefits still apply. There is a child tax credit that has been expanded. It's a little bit bigger. For the 2025, the child tax credit rises to $2,200 per child. Under the old law, it was $2,000, so it's gone up by a couple $100. But now it's indexed to inflation beginning in 2026. And it's an incremental bump every year versus prior law, and interacts with your overall itemizing and standard deduction picture. So the nice thing about this one is that always in the past, the child tax credit was just a set number. It's been various numbers throughout time, $1,000 sometimes, $1,500. Currently, before this tax law change, it was $2,000. Now they've raised it to $2,200, but they've pegged it to inflation, which means that will naturally go up each year with inflation. So it's no longer like a set amount. Now, there was a really special thing that hit through this tax law, and that was what people were calling the Trump accounts. And they're basically seeded savings accounts for kids, for children. The law creates a tax-advantaged accounts for minors with a one-time $1,000 federal deposit for children born roughly between 2025 and 2028. Families and others can contribute to those accounts with tax-deferred growth and restricted qualified uses, such as education and maybe first home. They're still kind of working out the rules on this one, but expect evolving guidance and state coordination to be in play with this one. Now, if your family has a new child in that window, open the account early to secure the federal seed and then maximize the compounding of that account. Now, there's clean energy credits. There's a number of savings here. There's several rollbacks. that apply. This law scales back or accelerates sunsetting for multiple clean energy incentive. Some of the examples of that are the residential clean energy and the energy efficient home improvement credits end after 2025. There's some EV related credits such as purchasing Teslas or other electric cars. Those are cut back or end earlier. Some of those end as early as September 30th. And so if you're looking at purchasing one of those cars, it's important to act quickly on those. And then there's utility scale incentives as well in there. So if you're planning to do solar, batteries or an EV purchase, you'll want to check the placed in service date on those and then check the rules as to when those phase out. I know like with solar on a personal residence, that's going to phase out at the end of 2025, so you're going to want to act quickly on that. The Tesla and electric vehicle credits, those end after September 30th, so you're going to have to act really quick on that. And the rule is that those have to be purchased and basically like placed in service. Like you have to be driving that car in order to get the credits. You can't just place an order for a car by September 30th and expect to get the credit. You actually have to take delivery and have the car, basically in your garage, in your driveway to get those credits. So then we talked about a number of things. So some of the items we talked about are permanent and some items we talked about are temporary. One of the most important permanent items is the lower individual tax rates and the tax brackets. When the Tax Cuts and Jobs Act was enacted back in 2017, a lot of the provisions were set to sunset and expire at the end of 2025. With those was the lower tax brackets. This new One Big Beautiful Bill extends those tax brackets permanently, so they now no longer sunset. So in order to get these brackets changed, they would have to change the tax law at some point because they're not just automatically set to expire. They are in the law, permanent, and will be that way going forward until an act of Congress makes a change to those. There were some temporary things that will just naturally go away on their own without any further action from Congress. The higher state and local tax, the SALT cap that we talked about, going from $10,000 to $40,000, that sunsets in 2029. Same things with the tips deduction, the overtime deduction, the auto loan interest, the $6,000 senior deduction, and then we've talked a little bit about the clean energy credits that are going away shortly as well. So there were a lot of temporary provisions in the tax bill, and then it was just really the tax brackets that were permanent. So if you're looking at doing some planning here in 2025 through 2029, here's like a playbook that you can do. So you want to run projections for itemizing versus taking the standard deduction, especially if you're in a high tax state. The SALT may swing your answer. If you have tipped or overtime income, start tracking that now. The deductions are generous, but documentation heavy and income limited. If you're looking at buying a car, consider doing a loan versus a lease in 2025 through 2028. The interest angle favors loans if you're under the phase out. If you're 65 or older in 2025 through 2028, then coordinate the $6,000 senior deduction with your charitable and retirement withdrawal strategy. And then if you have a kid that's born between 2025 and 2028, you want to open that Trump tax account early to secure the $1,000 seed and begin contributions. Then there's the clean energy projects. Those need to be confirmed and placed in service. The timing on those and revised eligibility before you sign contracts. So there's a lot of tax provisions in this tax bill, a lot of things to unpack. Like I mentioned, we're going to go through a lot more of these details in further videos where we're going to dive into specifically like the no tax on tips and overtime and senior deduction and auto loan interest. So make sure you subscribe to the channel and we'll bring you those updates.